Well, Canadian shoppers may be starting to pull back on spending as inflation erodes their purchasing power. An advanced estimate of retail sales for July out this morning showing sales declined 2% in the month. That was after a 1.1% jump in June. Those July numbers suggesting higher inflation and rising rates weighing on consumer confidence in this country. Ryan Bushell is president and portfolio manager at Newhaven Asset Management. He joins us for a deeper look at the economy and the road ahead in the markets. Ryan, it's always nice to have you with us. I did want to get your reaction. Does it surprise you to see signs of cooling for Canadian consumers given the inflationary environment?
Yeah, thanks, John. And no, not at all. I actually think there's more of this to come. We were already poised to see a spending pullback, at least on goods, following the binge we had during the pandemic. So that kind of durable goods spending, I think, was poised to come off anyways. And now it's being exacerbated, first of all, by food and energy, sort of in the first half of this year. And the back half of this year is going to be all about those interest rate increases filtering through. As variable mortgages reset, that's the first, the thin edge of the wedge. But all mortgages are going to be resetting higher over the next 2 or 3 years. Even if we get rate cuts next year, that's only going to bring us back to sort of the levels we are now, which is more than triple where we were just 6 months ago. So I think this is a drag for some time to come.
The wording that sticks with me from the veteran Bay Street economist David Rosenberg from earlier this week is that a recession at this point for this country is unavoidable. How are you viewing where the economy goes from here?
Yeah, it's a tricky thing, right? And the inflation side, I think that is yet to fully play out is the wage spiral cycle, right? Which is a psychological cycle, meaning, workers can't afford their lifestyle, they ask for a raise, then companies then have to raise prices to pay their workers, and that starts to get going, right? And so, the silver lining of a recession is it may put a damper on that cycle, but that's not going to be good for the economy and not going to be good for the average person, right? So I do sort of tend to agree that we're up against it, at least from an economic perspective. But there are pockets and areas of strength as well. So it will really depend on how these inflation numbers play out over the next 6 to 12 months.
On the strategy front, Ryan, you are keeping some of your investing money on the sidelines in cash, but you are also, in some cases, putting some money to work. We'll show our audience just a few of the names that you've been giving a closer look recently in a range of different areas. CAE, which actually is a stock that came up on Market Call yesterday, Aecon, NFI Group, the bus maker, just a few examples. Is there any common thread with these businesses and why you decide to put money to work?
Yeah, so earlier in the year, it was the renewables companies that had been really kind of punished coming out of 2021, and was able to put some money to work there again and the thesis there was long-term basis. We need more power, and we're going to need more renewable power as a part of that growth in the pie. And so that's turned out quite well. This time around, these companies are sort of more idiosyncratic, right? They have their own issues. So there really isn't a common thread necessarily tying them all together, except that, we believe they're sustainable businesses. They have a long-term future, and they're not that sensitive to the consumer. These are, an Aecon, for example, this is infrastructure spending. When we talk about, power construction projects and other infrastructure projects, they're going to be involved in that theme. Similarly, NFI Group, with their access to U.S. infrastructure spending in this new infrastructure bill, will be beneficial for them. But again, not related to necessarily like discretionary consumer spending. And so that's why I like those businesses. They all got hit pretty hard, either before or after their earnings announcements this quarter. And so, at levels that are 50% below their highs over the last couple of years, I think they're a decent risk reward on a long-term basis. Okay,
let's talk about the risk reward within energy. We kicked off this hour just talking about another choppy week for oil, and given how influential that group is in the Canadian marketplace, We've been getting a lot of viewer questions about the road ahead for energy. And I know, generally speaking, just because you're looking for companies that very much can deliver a lot of certainties, shareholder-friendly things, that you focus a lot on infrastructure. But what is your sense on sort of the general mood in the oil market right now?
Yeah, there's a real dichotomy playing out. So in the paper market, meaning the investment market, investor positioning is back to levels seen during the lowest levels of 2020. Meaning, in the futures market, the level of longs versus shorts is quite poor. But in the physical market, things remain tight, and so I would say that I think the U.S. government is doing their best work to try to lower oil prices right now on two fronts. Obviously, that's the releases from the Strategic Petroleum Reserve, which are ongoing, but a lot of chatter about the Iran nuclear deal. Now, I'm dubious as to whether they're actually going to consummate something there. I think maybe they'll just talk about it until the midterms and then let it go. It's a very difficult deal to get done just geopolitically with everything going on. I can't go into all of that right now. But I think and then there's the recession fears, right? So there's a lot of people kind of on the negative side of things, on the negative side of the boat. But the physical market is still pretty tight. China has not been buying. They're destocking. That's going to come back at some point. And then you've got European sanctions potentially kicking in on Russian exports coming in December for about 2 million barrels a day as well. And we also have Libya, which has brought on 1 million barrels a day that could go offline at a moment's notice. So I tend to think it's a middling, choppy period for oil here. Trading on headlines, but where I'm more invested is on the natural gas side, and no signs of high gas prices abating anytime soon when you look at storage levels in North America and what's going on in Europe.
Helpful.